Hello and welcome back to another one of our podcasts. Today we are going to be talking about business cash flow and how that all works for everybody. My name is Jack and I'm joined today just by Robyn, so it's just the two of us, so it's going to be a quiet one. But how are you doing? You doing all right?
Good, yeah. Fine.
Good. Yeah, no, I'm good. It's warm again, it's still very warm.
Yeah, a bit cooler than it was before.
Yeah, no, last podcast was very hot.
It was down there,
So, but yeah, no, so it's definitely cooler, but still hot. But so to say, yeah, we're going to go over cash flow. So, we did have a podcast about this before, which will be a link. I think there's a card. I think up here, maybe somewhere. If not, it'll be a card popping up on the screen. So you can go have a look at that one. That one was focused a lot on coronavirus back at the time because it was filmed during coronavirus. So there were some ways of trying to help people, but some of it is obviously still standing today, and we will be touching on it again today, a bit like the credit control stuff and all that. But I guess the first thing to go over really is what cash flow is and the understanding of that. So in the office, obviously me and Andrew do a lot of cash flow stuff, and I think Kim touched on it nowadays, but you haven't really got involved in it too much, I'd say.
Yeah.
In an actual projection, an actual cash flow forecasting, but you have an understanding of cash flow and what it is.
So just like the movement of money and like the ins and the outs and where you end up afterwards.
Yeah, definitely. So I think, yes, the cash flow, a lot of people think of it as your instant cash, I guess, what you've got. But one thing we'll be looking at today is obviously cash flow forecasting and how that will actually work. So a lot of businesses don't do it, especially from when we've spoken to clients before. They don't really think about it. They only think about the nows and not the futures, where cash flow forecasting and budgeting in that sense will obviously help a lot with that.
Yeah, definitely.
So I think the first thing we can talk about is credit control. So credit control, for anyone who doesn't know, is basically chasing your debtors for the money that they owe you. So if you've got clients paying on invoice, they've got 30 days to pay your invoice or something, then basically you're chasing them to pay that on time, whether that's before chasing or after or any of that kind of stuff. So that's the idea of credit control, which we do offer as a service. And we use some software called Chase with that. But I think having effective credit control is always a good thing, because you could say have hundreds of thousands of pounds worth of invoices gone out, but if it's all not paid, then you haven't actually got any cash.
Yeah, and that's, I guess, how it works in terms of cash flow, because you're getting that cash in. It's a way of making sure customers know how much they owe, and so they're more likely to pay it.
Yes, definitely. And we were talking as well before we started recording about, you sound like the P&L, profit and loss.
Yeah.
How a lot of people look at their profit and loss and go, oh, brilliant, I've made £100,000 profit. However, that profit doesn't equal cash.
Yeah, so it's not what's in the bank, is it?
No.
It's just...
So it could look really, really good, because a profit and loss normally is based on accruals basis. So it's effectively dealt with on the date of the invoice, not actually when you receive cash when you pay it out. So a lot of people will just look at that profit and loss and go, oh, brilliant, I've got loads of money. But actually their bank's got £2,000 in it because they've not been paid.
Or there's loan or anything going out.
Yeah, exactly, all that kind of stuff. So, I mean, a lot of people need to flip that kind of look on things with the profit and loss and start looking more into cash. And because QuickBooks now does have a cash flow forecasting tool built in. Yeah. It's okay. It's okay.
It's not terrible.
No, definitely not. And because, again, I feel like we're touching on this on every podcast we do now, but apps, cloud software, it's everywhere. Because beforehand, we used to do cash flow forecasting for clients, and it would be all done in Excel, and there'll be some formulas we were using to try and forecast what's going on.
Yeah, because I remember we did a basic one when it was COVID.
Yes.
And a basic Excel sheet.
Yeah, we did, which we offered to our clients, which I think is still available somewhere on our website. Probably. If I can find it, I'll put a link below. It's a very basic Excel sheet for the clients to use, but there is also extra stuff. So obviously we've got QuickBooks and they've got their basic one, but there's lots of tools or apps that link into QuickBooks that do an automated cash flow forecast. Again, they're not perfect. You do need to get involved with them a lot.
Yeah. To add a lot in.
Yeah.
It can't tell when things are being paid. I mean, there's the terms.
Yeah.
But
So a lot of it looks at historic data and then it starts trying to predict from algorithms and such. Similar to how we were doing it, I guess, in Excel. It's just that part's more automated, but it's still not exact. So a lot of the time we still would get involved in it, but it does give you a good picture, I guess, of where your cash is going to be. So you've got a big VAT bill coming up in a quarter's time. It was predicting, say, another £6,000. So that was going to be in nice little graphs and stuff, which I think with cash flows it was nice to see a good representation. Definitely. So I think that's apps. Again, we'll talk about them probably every podcast we do, but there is good apps out there as long as your data's up to date in QuickBooks.
Yeah, that is the thing, because even though it is based on historic, if your historic's not right, how on earth is it going to predict the future?
No, definitely, because a lot of the apps we've spoken about recently is stuff going into QuickBooks, but these apps will be relying on the information in QuickBooks, so everything's behind state. But another thing, I guess, then talking about cash flow and sort of what we're saying there about that bill, it's good to look into the future of cash flow forecasting, because say if you want to employ a new employee or you want to grow the business, you'll be actually able to predict or add in, say, another set of wages to be paid out and all this, and you'll be able to see what your forecasted balances would be.
See the affordability of it.
Exactly. Which I think a lot of people again don't think about. They think, I want to employ someone, we've got to pay some more wages, or they're just looking at the current and going, no, that's fine, I've got money in the bank. Whereas they've forgotten about, as I said, bounce back loans, for example, when they started getting paid back, there was a year where you didn't have to pay them, so at that time you've not gone, I'm a full employee, but you've not looked in the future, and then there's £700 a month extra you've got to take out in your loans. But I think in that sense, it's really good to look at and predict. And like I said, is it affordability? Is that so
affordability.
Definitely that route, I'd say.
Yeah.
But have you ever had any clients speak to you about cash flow?
In basic terms, about just kind of what they have available and kind of, again, relating it back to their bank and why is this not adding up to my profit and stuff like that. Not necessarily, can you do this cash flow for me? Yeah. But definitely, I think I've been asked quite a lot about certain areas of it, so because
I can think of actually one of your clients who think of it as the money comes in, their expenses are this, what's left is theirs and they can take.
Yes.
Whereas that's not actually how it works. So they almost empty the bank account, pay themselves their dividends or whatever, forgetting actually profit doesn't equal cash, because their balance sheet, they've got loans going out, they've got this or all that kind of stuff. So I think a lot of people do forget about that. So it's definitely worth always saying to people, don't ignore the profit and loss, but when you're thinking of cash and availability, ignore the profit and loss.
Yeah, and that is one thing about cash flow. It's like the new employee, it's important to see your affordability, not only for your kind of business expenses, but for your dividends, so you can actually see what you can afford to pay yourself.
Definitely.
So you don't overtake, and then you've got all this kind of director's loan to pay back, and the tax due on that, and it's a big no-no, which people forget about, because they think, I can take all that, but actually they can't, because also then on dividends they're paid out after tax as well, which people forget about, and they're not tax deductible. So, but that's another that's
podcast.
Another video.
But definitely it's worth looking at as dividends, because and again, if you've got that big VAT bill coming up, or your corporation tax bill, or your self-assessment thing, actually no, not with dividends, but you've got to look at where that cash is going.
Yeah.
You can't just pay it all yourself and then go, oh no, because then you end up having to pay it back in to be able to cover some things. Or then loans, I guess that's something else we can talk about. You could then look at getting a loan. If a capital purchase, I know you need a new machine, so you can then actually start to predict when you might need a loan or when you're going to purchase it, so you can start looking at that rather than being rushed.
Yeah, it's identifying those funding gaps. So when you can't afford to pay like either your current liabilities or if you need to buy a new piece of machinery because something's broken or whatever, you can identify using the cash flow what gap there will be, and so you can finance it in different ways and look at the loans available.
Definitely, and then with that as well, then you can start to forecast the different ways you're going to look at it and the interest you're going to have to pay each month.
Yes.
And then also how many years you potentially have to do it over. So if you've got really good cash flow, you might be able to do it on less years. But if it's not as good or it's not as high, then you then start being able to predict, actually I need it over 5 years instead of 3, or any of that kind of stuff, which is, again, really good to look at. So, because you don't want to get caught out.
Yeah, and I think that is the point, definitely, of cash flow. You know where you're at, and you can kind of identify where you're going to be. Yeah. So it's current, but with the forecast, it's also future. So.
And obviously, it's never going to be exact. You can't forecast every last little penny. You can't forecast that actually everybody wanted more tea this month, so you spend more on tea. But it gives you a very good idea of where you're going to be sat at. And also, sorry.
I was going to say, and then you can kind of budget for those discrepancies. So you have kind of like a pot for if anything goes wrong, and you know, okay, so this is available. Worst case. Yes.
So you literally just stole it out of my mouth. That's what I was going to say. Just saying about having a float, you can always say, I always want to make sure my cash flow doesn't go below £5,000. So then, like you say, anything that comes up, and your computer blows up, you're like, oops, I need a new computer, you can't access. Like for us, if a computer went down, we'd be stuffed. Yeah. We do have a backup, but we'd have to buy pretty sharpish. So we need to make sure we do have something there for those things. I think a lot of people do it like themselves. They have their savings ready, say if their car breaks down. Yeah. Kind of thing. So think of it like that, because a lot of people actually do cash flow forecasting personally, really. If you think about it yourself, you've got your savings, everybody not tries to save, but in your head, are you thinking, actually, I need to have this there? Or
need to have this amount available so that I can pay my bills and then have a bit extra just in case,
exactly.
Like a holiday, or if anything bad does happen, then you've got that kind of flow.
Yeah, exactly. So definitely always there, and especially when you own a car, you own a house, stuff comes up all the time. Like you're going through it at the moment with your car, it's been a nightmare. Yeah. Sore subject. But yes, I think it's the same in a business, or like self-employed, or limited company, or partnership, or anything like that. Yeah. Stuff comes up, or then you've saved up. For example, we've just got the office repainted. Not necessarily, not saying we've been saving up for ages to get the office repainted, but those kind of things, they're regular expenses. They're not your standard in your cash flow. So you could actually put that in there. So you say, right, it's going to be £500 for the office to be repainted. Oh, actually, August looks like a good month normally. So, which I think brings us on to a little bit of still you'll know on trends. Yes. Sales trends. I don't know if you want to, because you'll know.
So I was just going to say, like, it's good for all businesses, cash flow, but in particular the businesses that have high fluctuations, if it's seasonal or anything else, then it's important to kind of bridge the gaps between the seasons. Definitely. So if you've got like a really high month, like you said, in August, and then it gets to like October and you have very low sales, if it's based on weather or something, I don't know, then you've got to kind of bridge the gap in between the months. So you've got to forecast for the lower revenue, but probably same amount of roughly expenses. Yeah, definitely. So I think a few examples of that would be, say, tourist destinations. Yeah. Normally summer, obviously that's going to be quite a peak. Weather normally better. Yeah. And then in the winter, there's probably not going to be as many people there. So you've got to make enough and keep that cash there to get through the winter. And then on that as well, as people that sell stock, I don't know, paintings or carvings or objects like these little pyramids and so on. Those kind of things, you're probably going to have an influx at Christmas. Yeah. If you're selling at markets and such, going to Christmas markets, you're probably going to have quite a bit more sales. But then in the summer, it might not be as much. Yeah. So again, those trends are going to be up and down. And also with products, if you're launching new products, so you might have an influx there of your products, but then it sort of peaks back down to their normal levels. And again, that's all those trend lines, and you'll be able to see that on your cash flow when you do, because like I said earlier, it's very visual. Yeah,
So,
and it will definitely help you kind of look at. I know you might look at your bank and go, oh my gosh, I've got so much money. I'll be able to spend all this on like reinvesting in the business, basically like straight away, or even taking it, maybe paying yourself a dividend or whatever. But actually, if you look at the forecast, you go, actually, I need this as a float so that I can get through worst case, so that I can keep the cover for my expenses. I think you've got to still have like standard charges like rent, anything that's fixed, like electricity, that you've got to cover, so you don't.
Yeah, no, they're all going to be there. So which, again, good to look at it, because as you say, you could just spend all your money and then you get to go, oh, hang on.
Oh no.
Oh no.
And then just got to suddenly try and fund like this reduction in sales and like trying to get a loan last minute, or even like family loans and stuff, and it just causes problems.
It does, which you don't want to get involved in.
Definitely not.
Family loans are good, but sometimes they can go very wrong. So if you can avoid those kind of things, then obviously it's more ideal.
Yeah.
But yeah, well, I'm not sure I've got much more to say about cash flow. Have you got any questions?
I would say there are definitely a lot of metrics you can look into. Lots of different calculations that can be done to give you more of an insight into your business, and a lot of them are more complex ones that I would recommend an accountant.
Yeah, definitely.
Obviously, a basic cash flow you can definitely look at yourself, because you're the best person to know, okay, when these customers pay me, these bills are due then, and whatever. But yeah, to a certain extent, you definitely need someone professional to look at it and go, this is what you can afford.
Definitely.
This is how your business is looking, and kind of go from there.
Definitely. Did we touch on credit control? We did, didn't we?
Yes.
Yeah, fine. We'll talk about that for a second.
Briefly,
it was very brief, but yeah. Cool, excellent. Well, if anyone has any questions, put them in the comments below. But thank you again for joining us for another podcast. A bit shorter than the last one. Yeah, make sure you like, subscribe, check out all our other socials and all that kind of stuff. But otherwise, we will catch you in the next one. Cheers.